new interest limitation on deducting business interest expense work. And this is what was interesting because I did not know this. Again, this is written back in February, and this is the first I've seen about this. And I'm stunned I have it because I follow the tax law like crazy because I'm a huge fan of it. And if I could get the thing to work with me here. All right. So I want to go down to the Q&A part. I wonder if I can get that guy going because that's what's taking up the bandwidth. As long as I've been working the tax law business, interest expense has been fully deductible, which kind of makes sense because interest income is fully taxable. Why would Congress suddenly want to deny deduction for interest expense, particularly when it seems content to keep taxing interest income? So what this guy says, there's actually no suddenly about it. For years, Congress has kicked around the idea of fully disallowing a deduction for business interest expense, primarily for these three reasons. So a couple of things. I'm going to jump in there real quick. Remember, dividends are double taxed. All right. I wish I could get this thing. I don't know how to do it. But anyway, dividends are double taxed. The reason being is a corporation makes a profit. The profit they pay tax on, corporate interest or corporate income tax. Then they turn around a part of that profit they give to their shareholders as a dividend who's paid tax on it. Thankfully, under the Bush Act of 2006, the taxes were taxed much more favorably than ordinary income. They're taxed as qualified dividends for the most part. There are some other real estate trusts and stuff that are taxed as not qualified dividends, but by and large, if you get a Philip Morris or ConocoPhillips or something like that, you get a dividend from them as qualified dividend, which means it's taxed at 0, 15, or 20, whatever your tax bracket is, and then you add the Obamacare surtax of 3.8% if you're making over 250. Married filing jointly, or 200 if you're a single taxpayer. So dividends were taxed inefficiently before, horribly actually. So the corporation paid tax on it. They gave the dividend to the shareholder. Shareholder paid tax on it. That's double taxation. On the other hand, corporations were not taxed on interest income expense. They'd actually get to deduct the whole thing. So you would pay ordinary income tax on your interest that you receive from a corporate bond, but the corporate got to write the whole thing off. A perverse incentive, essentially, to get the corporations to borrow as opposed to giving dividends to their shareholders. So this guy says the levels of playing field for business investment between equity and debt. That's exactly right. Let's go back in time to 2017. You run a business but need cash to keep it going. That cash can come in one of two ways. You can borrow it, or you can find an investor contribute to the cash of the business in exchange for an ownership interest. The cash ain't free, however. It comes in the form of borrowing. You will be expected to pay the lender interest for the use of the funds. If it comes in the form of equity, you'll be expected to make distributions of interest to the investor or increase the value of the owner's interest in the business. And distributions, are considered dividends, which were double taxed. Here's the catch. Prior to 2018, payments of business interest expense to a lender were fully deductible. Distributions or share backs from investors, however, are not deductible to the business. So if you want to have your cash and at the same time lower your taxable income, you're going to prefer to finance your business through debt rather than equity. Could not agree with that more. In the old days, you got more of a business interest by issuing debt, i.e. bonds, that you could deduct the entirety of your interest payment as opposed to issuing equity or issuing dividends. But let's assume your business had a rough year in 2017. You barely had the cash to match your operating needs, let alone service the needs of your investors and lenders. Your investors, well, for the most part, they just have to sit back and deal with a momentary decrease in stock value in the absence of a dividend distribution. Not too much trouble they can cost. Lenders, however, are a different story. They want their interest payments and they want them now. And when they don't get them, debt holders can make claims on the assets of the business, essentially shutting you down because you missed a few payments. Just look at the country of Venezuela, for instance, right now. And don't forget, debt always takes priority over equity in a bankruptcy proceedings. Always does. Debt will have some ability to liquidate the assets of the firm. If they got a bunch of, large power transformers and steel holdings in the inventory, they can at least take ownership of that, where equity investors are just, SOL. And when your business goes bankrupt, you're either finished or fit to become president. Okay, I get that. That's fine. There's really no in between. Always got to be a ding on the Trumpster. Okay. As a result, due to the inflexibility nature of most lenders, a business that relies heavily on debt is more likely to go bankrupt. I completely agree with that for sure. But what if the interest deduction were fully eliminated? As the business owner, there'd be no tax incentive for you to borrow rather than to seek an equity investment. Thus, the theory goes, could lead to more stable business for you and a more stable economy for all. And if we look at all the leverage buyouts, all the leverage just is horrible. The stuff that has caused significant bankruptcies, these LBOs and whatnot. What was the guy's name? Milken, who came to the high debt and to buy out these companies, and just these guys. I mean, some of these guys done good things. Some of these guys done horrific things, which is leverage. Because the facts are, high leverage can lead to high returns, but high leverage can also bankrupt a company and a country as well, as we've seen in various countries throughout the world, not in the most recent history of the last 20 or 30 years. It creates simplicity. When you allow businesses to deduct interest expense, big businesses will abuse that deduction. A primary example is the earnings strippings, where U.S. corporations borrows money from a foreign affiliate in a low-tax jurisdiction. When the U.S. deducts the interest it pays on the borrowing, it strips the earnings out of the pre-2018 high-tax U.S. and moves these earnings to a lower tax or different locale. That's beyond my rank there, but I get what he's saying. Basically, I'm taking a deduction on one end, I'm borrowing on the other end. I get to deduct the deduction on this end and give it out the other end. I get that, but that's beyond my ability to comprehend. It raises revenue. Boy, does it. Some estimates say that if Congress were to repeal the business interest expense deduction, it would raise $1.23 trillion over the 10-year budget window. That would fully offset the impact of the 14 reduction in the capital and the corporate tax rate. Okay. So let me just real quick, what I was thinking more along the lines of is, when you think about it from a perspective of a shareholder or an investor, be it into the bond market or the dividend market, a couple of things that jumped out at me, and I've been thinking on this a little bit. My initial reaction was this would probably, let me get back to the live screen here. Hold on just a second, my friends. Let me get back to there we go. I was thinking this is getting rid of the business deduction. And again, it's not a full business deduction. You can still deduct. I think it's up to 30% of your corporate AGI or something. You can still deduct a significant amount of interest expense, but you couldn't deduct more than 30% of your AGI. Either way, at the end of the day, what I was thinking about, though, when it comes to the business deduction, getting rid of some of that, is that it could make dividends more valuable. But then I started thinking about it, and I started thinking maybe not so much, because there are companies that borrow to pay dividends. Right? And that is companies who don't have the good quality cash flow that you want. So they're going to borrow on the debt market, because borrowing today is so cheap from a debt market. Let's say you can borrow at 3%, you deduct the entirety of that 3%, and then you can actually eat those losses for many years to come, those interests against your net cash flow, net operating losses, carry forward, all these things. And then you could turn around and invest the borrowed money in the dividends to drive up your stock price. It's just shenanigans across the board, but it works. People do that. Companies do that all the time. So if you got rid of that deduction, it's going to make that whole scenario kind of less efficient. In fact, I think that might be even subject to lawsuits by big shareholders, because they're saying you're borrowing to pay out a dividend when you no longer can get the full deduction on the borrowed interest. And I think that'll actually hurt dividends. But in the long run, I think it'd help, because the companies that still pay dividends are probably paying it with real cash, real positive cash flow. Secondly, I think it might actually reduce the amount of bonds in the market. Now, when you reduce the amount of supply, what's going to happen is there's going to be less supply, which is going to increase the price. It's going to increase the price of the bonds, because more people are going to want the less supply, and that's going to decrease the yields. I know that's kind of counterintuitive, but just hear me out. At the end of the day, less bonds. There'll be more, or the same amount of people competing for less bonds, which means the companies can offer less interest to the people who want those bonds. So I think that actually will reduce potentially the yields that corporations and inherently governments, I mean, they're competing entities. If I can get 5% on a corporate debt and 2% on government debt, if I don't think that corporate debt's going bankrupt anytime soon, I'm going to start looking at that very profitably, and I'll buy it up, which ultimately will drive the price up and drive the yields down. I mean, I get into other videos on how bonds and dividends work and whatnot, prices versus coupons, prices versus the actual dividend. Don't want to get in that here, but just remember, at the end of the day, if we have an even Steven thing, 100 buyers of your debt, and you're averaging 100 bonds, so each guy has 100 debt, 100 is 1 to 1. Now you reduce the bonds by 20%. So now there's only 80 bonds out there, but you still have these 100. Well, these guys are going to compete against each other in auction, and it's going to make the price of the bonds go up. When the price goes up, the yields go down. So I'd anticipate if there's going to be less debt issued, it'll make the bond yields go down too, which will be which could have an effect on your own portfolio. Absolutely. At the end of the day, too, everyone looks at debt versus equity. That's what they do. The bond market is paying X, and as the bond at least has some security in the assets in the company, the stock market is paying Y. There is no security in the assets of the company. So if the bond market reduces its yields, that's going to make the dividends look more attractive, which would mean the stock could potentially go up. Maybe, again, it's tough to say about that, but I think that would make sense. Now the bond yields go from 3 to 2, and I'm just using that for example. All of a sudden, a 2% dividend looks a heck of a lot more attractive than a 2% bond. And the reason being that bond to me as the investor is still taxable as ordinary income. That dividend yield to me as the investor is still taxed as qualified dividend. Significant difference there. The dividend becomes look a lot more attractive. Thus, theoretically, more demand would go into the dividends over the bonds, and thus increasing the price of stocks overall. So what's going to happen at the end of the day? You have less stocks issuing dividends. The stocks that do issue dividends are going to be more cash oriented, more solid cash, like Apple. We're making money hand over fist. They got tons of money in the reserves, and they have dividends that they're paying out just because they got too much cash. And so they're going to say, okay, at the end of the day, even though it's double taxation, we got good positive cash flow. We're strong from a financial position. We're going to continue to pay our dividend, or if we want to get a bump up in stock price, we're going to raise our dividend, which will thus increase a bump for stock prices, because company or investors will say, whoa, they're very comfortable in their stock. They're raising their dividend, and make sure no one's commenting here. They're raising their dividend, which means they're pretty comfortable in the cash flow projections. And the facts are that some of the other companies out there have not had a dividend simply because they could not borrow to finance it. Whew, a lot going on there. I know, but it's interesting. The tax code is fantastic, and I love following the tax code because there's so much going on here. And you need to be paying attention to this, because at the end of the day, if the corporate interest goes down because the companies there's less bonds on the market. In fact, one of the articles I read in Forbes actually said more companies would be less inclined to issue debt. Less companies issue debt, less bonds available, and the same number of bond buyers out there. It means the price of bonds goes up. The yields of those bonds go down, which means the dividends that are sitting over here become a whole heck of a lot more attractive, my friends, which means those stocks could jump up a little bit. And again, that might have already happened. I don't know, but it'd be something to keep your eyes on. So pretty good article in Forbes. Was not aware of this from a business entity perspective. This is huge, gigantic. This tax code is just phenomenal, and tons of just huge changes in the tax code. Basically getting rid of the AMT, alternative minimum tax, for most taxpayers. Wonderful. They've been saying to do that for years, and neither Democrats nor Republicans stepped it up. Trump is the guy who got it done. So you got to give him credit. He's the guy who got it done, getting people off the AMT, because more and more people are being subjected to it. When, again, the AMT is originally only for 300 very wealthy families who weren't paying taxes. It ain't 300 anymore, that's for sure. In 2018, they got rid of that. It's still out there, but the vast majority of people fell in their AMT will no longer be falling under that. In fact, I was just doing some tax review for a client of mine, and I said, it's going to save about $4,000 or $5,000 a year right there alone in taxes, just because the AMT has been gotten rid of. And they make pretty good money, but that's real money, man. That's $4,000 to $5,000 they can use for other things for sure. All right. Well, don't forget to subscribe below. As always, have comments, questions, concerns, put them in there for sure. Thumbs up always help, and don't forget to hit the little notification bell to be notified of future content. We'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.